welcome everybody to another segment of Lewis at Large. Yours truly, Warner Lewis, once again from our world-famous flight deck. And, of course, Smart Talk Radio is certainly in your future. This segment going to be a good one. We're going to be talking to one of America's leading financial experts. What does that mean? Well, a little bit more specifically, Jason Vanclef is a financial planner and strategist and the mastermind behind the unique wealth code asset class diversification model. Sounds complicated. It's not as complicated as it sounds. He will talk about that a little bit more. Most recently, a brand new work called the Wealth Code 2.0, How the Rich Stay Rich in Good Times and Bad. And he will share some of that knowledge with us indeed. Jason, how are you, my friend?
Very good. Thanks for having me.
You know, we talk about the world of financial planning, Wall Street, investment strategies, portfolios, etc. And a lot of people out there are thinking, oh, great, here we go, another snake oil salesperson. That's not fair to you. But, boy, there is an attitude out there like that, isn't there?
It is, unfortunately. I mean, over the years, I've seen thousands of people, and one of the major things I've seen across my desk is just the sheer anguish people have when they sit across my desk because they think I'm going to be like every single other person out there. And I spend a lot of time educating. I said, this is the system. Let me show you how everyone's paid. Let me show you the different concepts out there. And more importantly, let me teach you a different philosophy than what we're unfortunately given almost every single from most advisors, which is a Wall Street model of stocks, bonds, and annuities only. And so to teach them about a different concept and to give them a lot more confidence in terms of their retirement goals.
Well, one of the things that we want to do here is we want to talk about the Wealth Code 2.0, but we also want to keep it to where, you know, John Q. Public, including yours truly, can actually sort of follow along and understand some of this. But let's start with this, Jason. Start with the basic premise for the Wealth Code. How is it different than sort of traditional investing strategy, and why should we care?
Well, you know, ironically, when you describe traditional investing, it's almost the viewpoint of who you're talking to, because Wall Street will tell you that traditional investing is investing in stocks, bonds, mutual funds, and annuities. Yet, incidentally, the very wealthy, that is not traditional. That is the unusual. They rarely invest in those or asset classes. They typically invest in things like real estate, oil and gas, equipment, collateralized notes, things of that nature. I like to describe wealth as a financial table. And unfortunately, John Q. Public goes to the vast majority of advisors, and they will say, you only have this leg to invest in, stocks, bonds, mutual funds, yet when that leg of that one-legged table breaks, as it did in, for instance, 2008, your table crashes down, and you're meant to pick up the scraps again. Whereas what we've taught our clients is you want to have a table with many different legs, and the idea of the Wealth Code was to teach people how to get access to these different concepts and where to go looking for it, because most people, if you walk into your Morgan Stanley or whoever, they're not going to talk about this. So it's about putting lots of legs on the table, knowing that there's only one guarantee in finance, and that is something will go wrong. Nothing's perfect. Everything has its issues. And the idea is to teach yourself about these, get a good enough sense of what they are to make your own decisions and move forward.
What, in your opinion, and again, you've been doing this a while, but what is the basic mistake, in your opinion, right out of the box, do you think that the amateur investor or the traditional guy on the street makes?
One to think, for instance, I have, whatever stocks, Google, Apple, blah, 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 a whole bunch of them. And I have foreign, mid-cap, domestic, I have all these things. And to think that you are diversified. That's the single biggest mistake people make. I like to describe it, one of the sections of the books is leaks in the bucket. I mean, it's one thing to build your wealth. It's another thing to have leaks draining the money every year. So as fast as you put it in, it's coming out the other side. So limited investment diversification is a major mistake. Again, if those investments in the stocks, bonds, mutual funds break, you fall. Income tax planning is another leak in the bucket. People think that there's two systems of taxation out there. Justice Leonard Hand from 1914 said the two systems of taxation, those for the informed and those for the uninformed. The very wealthy very commonly will hire individuals to teach them about the different strategies. So paying too much in tax, excessive fees that you're paying to your advisors, not understanding how the money is being pulled from your money. These are some of the major mistakes people make, which keeps them from moving ahead.
Well, let's start with and again the whole wealth code. Again, you're talking about what the traditional investment firms would say. Well, no, wait a minute, this guy's way off the deep end here. What kind of criticism do you think they would level, so to speak, at you?
The number one thing they would say about what we do is that a lot of our investments are illiquid. They are not readily sellable the next day. And that is one of the major premises that I argue against is the problem with liquidity. Sure, stocks are liquid. Yes, I can have my Apple stock and I can sell it the next day. The problem, though, is we human beings are emotional. We are driven by fear and greed, and we tend to panic. And the old notion of buying the top and selling the bottom when it's supposed to be the other way around is unfortunately all too often what we do. So what we try to do, a lot of the times when you look at people's wealth, everyone from the average Joe to the wealthy individual, ask them, where does a lot of your wealth come from? They might actually point to their house that they bought 20 years ago, and they might have bought it at the top of the market of 1989, for instance. But they go, yeah, I paid $70,000 for my house, and now it's worth $250,000. Well, I've actually made quite a bit of equity. Well, you did it because of time. And for instance, in the crash of 93, 94 with real estate, most people weren't selling their houses in a panic because, one, it was difficult to sell. So they wrote it out. So having things that are liquid, unfortunately, allows us to panic quite often. That's the number one criticism that we get is, all their ideas, many of them are tied up. It's about balance. You have some that are tied up, you have some that are not. You mix and match them. That's probably the biggest criticism.
What about, and again, you talk about the stool, and the stool meaning one-legged, two-legged, three-legged. A lot of businesses have a business premise that works kind of the same way. Explain what you mean.
Well, in terms of our case, stool is three legs, and you hear this, the different legs. I talk about a table with 30 different legs on it because there's so many different concepts, and common sense is put as many of them as possible. And the other premise is to have things that are putting checks in the mailbox every month. Cash flow, that's another major focal point on the very wealthy. Is they tend to have ideas that put checks in the mailbox every month. Rockefeller, a week before he died, said, what was the key to your happiness? He said, checks in the mail. So having a lot of these different ideas, as well as doing the other concepts with a client, for instance, asset protection. It's one thing to make it. It's another thing, unfortunately, to have, someone rear-end you on the highway and then they sue you for everything. Income taxes. I mean, you make $1, you pay 50 cents back in taxes. You're going nowhere. So to really focus on these different concepts to keep yourself moving forward.
Again, if you just joined us, yours truly, Warner Lewis, from the flight deck of Lewis at Large Radio. Our special guest this segment, we're talking about the Wealth Code 2.0 with one of America's top financial planners and strategists, Jason Vanclef. And Jason, again, a lot of what you're talking about, people are going, okay, well, then give me some specifics here. Tell me what me as the average Joe can do that maybe was reserved only for the wealthy years ago.
Well, the average Joe and the investor around there, and the major premises of the book was to teach them what these other concepts are that they're not hearing about. Obviously I can't name specifics because I'm a fully licensed securities advisor, but what I can say is there are many investments that are in different classes. For instance, real estate classes where you can be in diversified portfolios of different types of commercial stuff and be in common sense ideas. For instance, in this day and age, I don't want to necessarily be in an office or retail. I want to be in apartments and storage centers, in long-term care facilities. I want to be in things that make sense. They can be in different categories. Right now in this day and age, we're in a lending crisis. So we're getting access to clients and a lot of these investment concepts that can take advantage of that. So for the average Joe out there, the key is, and it doesn't take big minimums. A lot of times these investments have, one of the things that we've been finding is finding things that, have very small entrance fees, basically, to get into them. and define that. So that's kind of the idea. Is education is the number one thing, and that was kind of the idea with the book.
How and again, there's as many different investment or non-investment strategies as there are people. Any particular sort of stereotypes or any generalizations that you can make for people, knowing that everybody has some different goals?
Everyone definitely has different goals, but I think everyone's goals are the same, which is they want to secure retirement. They want to know that every month there's a couple bucks coming back in the door, whether they got out of bed or not. And a lot of times, with the Wall Street methodology, that's not a very good technique for generating cash flow. Look at the stock market today. Everyone's so happy that, here we are at Dow 15,000. But the reality is we were at Dow 14,000 5 years ago, and Dow, roughly 11,800 13 years ago. If you think about this, and the S&P, we've barely moved in 13 years. So that isn't good for security. Whereas if I had a simple investment 13 years ago or 5 years ago that was spitting out, let's say, 6 or 7% cash flow every year, I'm at least moving forward, and I can be patient. So the idea is putting a lot of these things together and learning about what they are.
What about just in general? As you mentioned, there's been a lot of hype, a lot of talk about this incredible run-up, or at least percentage-wise recently, in the stock market, but there's still, as they say, a lot of money on the sidelines. Overall, what role should liquidity/cash play in somebody's portfolio?
Well, I think the money's on the sideline, and you listen to the CNBCs and the Bloombergs, and everyone's like, why is the general public? And it's really kind of alarming the way they'll say, why is the general public being so silly not investing their money? Because everyone looks at this and they go, well, this market is being run by the Federal Reserve and the printing of capital. And so people are naturally skeptical, as they should be. Every time the Federal Reserve in the last 3 years has pulled the cookie jar away, they did it April of 2010, the market crashed. They did it July of 2011, the market crashed in August. They did it again last year, and the market starts crashing again in May. They should be skeptical. So it's about seeing these different concepts and really, saying, okay, how can I get my capital working for me? I have all this cash. A lot of people are socking away in their mattress, which is going to kill them with inflation. But getting it working there, you have to take some risk with money. Nothing's perfect, but you got to get it working out there somehow.
And again, we understand and respect your position as an advisor, and there are certain things you're allowed to speak on and not. But just in general, one of the things that I'm curious about is there may be from time to time reasons someone might not want to necessarily pay off a mortgage. Let's talk in the same way. I've got a daughter looking at a new car. Mm-hmm. Is it always a good idea to pay cash? Is that the best idea? A couple of those kind of questions.
Yeah, things like this. You hear this time and time again, pay cash for your car. Let's say there's a $20,000 car out there and you want to pay cash for it. But, let me change that philosophy. What if I told you I had a mutual fund that if you put $20,000 in, I can pretty much assure you that in 5 years that $20,000 will be worth $5,000, and it will cost you a few $100, $300-400 a year in maintenance fees. You'd look at me like that's the dumbest idea I've ever heard. That's the same concept of paying cash for a car. You're buying a depreciating asset. In this day and age, now, there's right and wrong for everyone, and no one is exactly the same. But like, for instance, today with housing market, because of the Federal Reserve pushing interest rates down to historic lows, it doesn't make a lot of sense to pay off a house. Every time you put $1 into the principal, you're effectively earning your interest rate minus the tax benefit. So if your interest rate was 3.5%, maybe you're in a 20% bracket, you're really only earning a little over 2% and some on that money. Can you get that money working harder for you somewhere else and just keep paying the minimum? Because incidentally, by paying just the base on a 30 or fixed mortgage, you really kill the banks. They don't want you to do that. They want you to pay principal. So no two people are the same. Some people, it makes great sense to pay off their houses, but for a lot of people, it doesn't make sense because you can have that money working harder elsewhere. And for a car, we always like to talk about you buy and invest, or you get investments that can earn more than the car payment. If you put your $20,000 somewhere and it pays you a couple $100 or whatever, or maybe $150 a month, make that your car payment. When your car is finally paid off, guess what you still have in your pocket? Your original capital.
Well, again, the wealth code, the whole premise, as you said, is true diversification. Can you illustrate what do you really mean by that? And we've talked about the multi-leg financial table, but again, it's not just buying high-tech stock versus a consumer staple versus a biotech company. It's much faster than that.
Yeah, because, again, when a year like 2008 rolls around, it didn't matter if you had stocks, bonds, mutual funds, or anything. They all got clipped in half. So when we talk about a truly diversified table, I need categories that are not related to the other. For instance, real estate. If I buy a REIT, a real estate investment trust on the stock market, they got killed in 2008. And it wasn't because the real estate was crashing, it was because they were effectively stocks on the stock market that people were panic selling everything. If I do real estate for a client in a REIT, a real estate investment trust, I want to be in what are called non-traded REITs, simply because then I can look at the concept of the portfolio and say, okay, I know what their cash flow is, I know what the properties are doing, I can evaluate it, clients can be part of that, and we can be in something not correlated to the stock market. So I want to be in a lot of different ideas that aren't tied to the same flow of each other. And so expecting a leg or two to break on our table is the given. So if I have 20 legs and a few legs break, I have 17 legs that are fine and will support our financial wealth.
Right. One of the things I noticed in some of the notes here, these direct participation programs, DPPs. Explain kind of what those are.
One of the major, if you look at the very wealthiest portfolios, 60 to 70% of their portfolios are in quote-unquote alternative investments, which are generally direct participation programs. So let's say, let's talk oil and gas, for instance, and it's right for some people, it's definitely not right for others. That's typical. But if someone might say, I want to invest in Exxon stock. Okay, great. When you invest in Exxon stock, you're the last on the food chain. After the oil people have been paid, the bonuses have been paid, the salaries, the light bulbs, the stockholders are the very last to participate in the profits. A direct participation program, for instance, in oil and gas, puts you at the very front. Maybe it's a royalty program, whereas you own the land where oil and gas are. And when a drop of oil comes out of the ground, you are paid first before anyone else. So you are directly in line. This is commonly has been with the very wealthy, but for most people, they didn't have the capital to do it. So a direct participation program is basically a pool of investors putting their money together, then become a bigger player to take advantage of these investment opportunities.
Well, it is a fascinating concept indeed. I'm curious as to why are these kinds of opportunities not available through the traditional brokerage houses?
Yes. Oh, boy. The vast majority of advisor firms, to be really blunt, they do not represent them. And the reason they don't is because they look at their own business model and they look at their own stock price and they say, what is better for our long-term prosperity? I've had a very different viewpoint, which is you take care of the clients, they have big, happy, smiley faces on their, and they'll come back, and what goes around comes around. So, yes, you have to work with firms that, are open-minded enough to deal with these different investments. And a lot of times people go to an advisor and says, what about this? And that advisor will say, oh, that's terrible. Well, the reason they say that is because, one, they don't even know about it, and two, they don't have access to it. So, of course, they're going to tell you it's bad. So, again, working with advisors that are open-minded and have the ability to work with them is very crucial.
Well, let's, and again, we're talking to Jason Vanclef, one of America's top economic strategists. We're talking about the Wealth Code 2.0, how the rich stay rich in the good times and bad. I am curious, the clients that you work with, especially those sort of at the top of the economic food chain, they do seem immune from the whims of the economy.
Which is the title of the book, How the Rich Stay Rich in Good Times and Bad. Incidentally, we have always said in times of chaos, the rich prosper even more. I mean, look at today. We are in a lending crisis. Right now, the banks are not lending to anyone but lending back to the Federal Reserve. So you have all these segments of the economy that are falling apart, where small groups are stepping in to take advantage of it. Example, we have a group that's taking care of hospital debt. So patients come in and, the hospitals aren't able to collect the debt. So this group steps in the middle and is doing it and doing a great job for the patients, great job for the hospitals. So there's a lot of avenues to get involved with. But yeah, in times of chaos, the rich will get into these concepts and will be able to prosper even more, unfortunately.
Well, again, the work is the Wealth Code 2 by Jason Vanclef. Jason, two issues here, or two pieces of information we want to share with our listeners. How can people find out more about the Wealth Code 2 and its premises And also, how can people find out more about the work that you do?
Go to the Wealth Code, thewealthcode.com. That's probably the simplest thing. And then my firm, of course, is vfgroup.net. But thewealthcode.com is the easiest way to find out all about us.
All right. Will there be a Wealth Code 3.0, or are we...
It's funny you say that. As soon as I finish this, and all of a sudden, clients come in and they're reading and they're like, oh, what about this? And also, I already have a list of 3 pages of stuff for 3.0, so that'll be a while, though. This was my blood, sweat, and tears went into this one to give people the best I could give them.
Before you get out of here, I am curious if you would prognosticate a little bit. Where do you see short, medium, and long term the health of the American economy?
Yeah, it's
a tough one.
We're in, unfortunately, such a manipulated economy right now. If you told me 2 years ago that the United States debt ratings could be cut and our yields on bonds, which should go up because of that, would tank like crazy, I would have thought you were crazy. But we live in a very strange world. But the reality is, this is not unseen before. We've seen this throughout hundreds and hundreds of years of history with economies where, frankly speaking, you have money that's being controlled and artificially manipulated, and it doesn't end well generally. So the best thing to do at this point is to learn about different ideas and different concepts, to be in many different ideas. Nothing's perfect, but just spread yourself out all over the place, knowing that if things get really rough, this will give you the best fighting chance.
Well, again, appreciate it, and best of luck to you. Thanks for spending part of your day, and we'll talk to you again at Wealth Code 3.0.
Yeah, I love it. Thank you for having me.
You bet. We will be back with more right after this on Lewis at Large.